we're learning more about the nation's total economic output. What is this new report telling us?
This report signals that the first quarter of this year, there was an economic slowdown, a contraction. We haven't seen that since 2022 during the height of COVID. Now, the U.S. economy contracted down 0.3%. That is the preliminary estimate. Compare that to what we saw in the last quarter of last year when the economy grew by 2.4%. And the reason that we saw this contraction is largely because of imports. The U.S. imported a ton of goods, and imports is a subtraction from GDP. Also, there was a weakening, a decline in government spending that was primarily led by federal government cuts, and we can attribute a lot of that to the DOGE cuts that we have seen. Consumer spending softened. You also had government spending, as I mentioned, that weakened. You had the investment increase a little bit, but really the imports was the biggest drag on this first quarter GDP reading. Just look at the comparison from what we saw in the last quarter of 2024. You had imports decline a little bit by 1.9%. But if you compare that to what we are seeing in this quarter, this projection, imports soaring over 41%. You can see it on your screen right now, Wolf. And that is, of course, because of President Trump's tariffs. Businesses wanted to front load a ton of product and goods, get that into the country to beat the tariffs that he was messaging was coming in April. This report looks at January, February, and March. This is a preliminary reading. But of course, the question is, Wolf, what does this mean for a recession? The definition of a recession is 2 negative quarters of GDP. Here is one. What happens in the second quarter? And just look at how markets are reacting. Look at how Wall Street is reacting. They do not like this. The Dow down almost 700 points as Wall Street is now looking at this and thinking, are we heading for that recession that many economists have been forecasting? Wolf?
They certainly have. Vanessa Yurkevich in New York.
All right, with us now is Diane Swonk, Chief Economist at KPMG. Thank you so much for being with us. GDP down 0.3%, the first contraction since 2022. Another economic report out this morning showed that core prices actually increased more than expected. So when you see growth going down and prices going up, what does that spell for you?
Well, it is a problem. I think this quarter is sort of an anomaly for exactly the reasons said. We saw a lot of front running of tariffs. We saw inventories balloon at their fastest pace since early 2022. That's when we were still restocking in the wake of the pandemic. This was front running tariffs. In fact, investment spending on information technology, which are in the crosshairs of tariffs, that increased more than a stunning 69% annualized pace in the first quarter. That is just, hard to believe. But that's going to borrow from growth going forward. And we also saw in today's ADP report a much slower gain of job gains. Now, that doesn't necessarily predict what we'll see in the official report on Friday, but one thing that was really important in that report was where the declines were. They were in small businesses. Those are businesses that really have the least amount of margins to be able to deal with tariffs, and that's one of the things we're very concerned about going forward, is that we could see red ink in the employment data as we get into May and June.
Yeah, you're talking about the ADP report there, which said there were 62,000 jobs added in April after 147,000 were added in March. So a pretty sharp decline there, and the expectation had been for 134. So take the ADP report, take the GDP, take core prices. What kind of soup or cocktail does this make right now?
Well, sadly, what it makes is for something the Federal Reserve is quite worried about, and that is stagflation. We are worried that we are going to slip into a recession as we get into the summer and through the end of the year, and the Fed will not be able to cut rates as rapidly as it would like. In fact, it'll be on the sidelines because of the stagflationary nature of tariffs. It has to wait through the tariff-induced inflation to see how bad it is and for it to come off before it can actually begin stimulating the economy. This is very different than what we saw a few years ago when the Fed was raising rates to fight inflation. we had a cushion of savings back then. We don't have that now. When you see the stock market down and the U.S. economy dependent so much on the top 10% of households, accounting for almost half of all consumer spending gains, really horrible inequality, that also takes out that support for spending.
I want to read you just the very top of a statement that President Trump put out shortly after the GDP numbers came out. He's talking about the stock market, but one might presume that he was also referencing the GDP numbers. He goes, "This is Biden's stock market, not Trump's. I didn't take over until January 20th. And then he goes on to say tariffs won't kick in for some time here. He did not take over till January 20th, although, 2+ months of the first quarter, he was the president, and the last quarter of growth under President Biden was 2.4%. My question to you is, how much of what we're seeing in these economic numbers now are a result of policy decisions?
What we're seeing is a lot of result of policy decisions. The front running of tariffs is the front running of tariffs. We know that not only did imports soar and shaved about 5% alone off of GDP growth in the first quarter, ending up many of them in inventories and spending, like I mentioned, in the information technology space. But we also know that that has a payback to it as we go forward. And as those inventories are depleted, we know that already shipments between the U.S. and China, particularly from China to the U.S., have almost come to a standstill.
Yeah, and again, and markets continue to dip this morning after the opening bell in reaction, I think, to these GDP numbers. Diane Swonk, thank you so much for being with us this morning. Appreciate it.
Joining us right now is Larry Summers, a former president of Harvard, also, of course, Treasury Secretary under President Clinton, director of the National Economic Council for President Obama. The U.S. economy just had its worst quarter since 2022, we've learned. GDP, well, one coming in weaker than expected, and also seeing this dramatic fall off from the fourth quarter. What are we looking at here, Secretary?
Look, this has probably been the least successful first 100 days of a presidency on the economy in the history in the last century. We've seen the stock market go down by as much as ever. We've seen the dollar go down more than ever. We've seen forecasts of unemployment go up, forecasts of inflation go up, forecasts of the odds of recession go up. We've seen consumer confidence collapse. We've seen businesses take back all their previous earnings projection. So this has been a disastrous 100 days for the U.S. economy. And what makes it more disastrous is it's not something that's happening in markets. It's not something like an external shock, like a hike in the oil prices. It is all the consequence of policy announcements by the President of the United States, principally with respect to tariffs that have created immense amounts of uncertainty, immense amounts of question about whether to buy American goods. This is the quintessential self-inflicted policy wound. When markets have behaved well, it has not been because anybody has made a favorable judgment on these policies. It has been because people have seen increased hope that the administration would switch course. There's a market where people can make judgments about the odds of recession. It spiked up this morning and is now saying that there's a 7 in 10 chance of recession this year. That chance was less than 1 in 4 just 100 days ago when the president was inaugurated. What we need is to change course, to set a new steady course away from tariffs as the central element in U.S. economic strategy. Until we have that in place, I fear that our economic situation is only going to deteriorate. Consumers are going to see higher prices from everything from the clothes they buy to the houses, to the repairs they want to do, on their houses. We are going in the wrong direction as a country economically right now.
Yeah, as Mary Barra of GM said just last week, consistency and clarity is what she needs. That's for sure. You can assume a lot of people feel exactly the same way when they look at the GDP report coming out. Secretary, thank you for your time.
It's an almost universal pattern.
Thank you so much, sir.